Okay, welcome everybody. Boy, I like that countdown, producer. You were good. Hey, welcome everybody to a live Q&A on tax and legal strategies. Very important topic before year end. So I'm here for you, Mark Kohler, CPA, attorney, partner in a law firm, partner in an accounting firm, and CFO of Directed IRA. So I'm hoping I can answer a lot of your questions. If I can't, we're going to bump it to the next Q&A forum, which will be on our podcast, I think, next week. So don't go anywhere. It's amazing what you might hear from fellow entrepreneurs around the country. Questions that you're like, I never thought to ask that. Wow, that affects me. So actually, the live Q&A open forum here, live on YouTube and Facebook, is actually one of the most viewed of the broadcasts, no matter what topic I give. So I'm here for you. So I'm going to jump into some Q&A that we've already received in advance because people knew that's what the topic was today. I got my trusty Rockstar here. I am now sponsored by Rockstar. I can get 2 for $3 at most convenience stores around the country. So there you go. Feel jealous. Okay, first question. Should I ask, is it the auto question? Do we have a first name for him?
Yeah, Gary Thomas from Utah.
Okay, Gary from Utah said, Mark, I've read your article on the auto deduction, and I give 7 rules of thumb on should I do mileage, should I do actual, can I write off a car or truck that I buy in the next 3 weeks? In its entirety, maybe? The answer is yes, all the above. The auto deduction is the best it's been in 30 years. It is off the chart. So if you want to read the article, go to markjkohler.com, go to the blog, and in the search window, just type auto. And it's an article for 2020 that gives you some incredible examples and rules of thumb. Well, Gary's question was, Mark, in your article, you don't say anything about financing. That financing would affect the depreciation or financing might affect the write-off. Well, I didn't mention it because it doesn't. You're going to love it, Gary. It's the same freaking write-off, whether you buy a car, truck, or SUV with cash, or you put down $1 and finance the whole thing. You get the same write-off. So don't worry about it. And with the new Tax Cuts and Jobs Act auto deduction, you can do actual or mileage, and you can buy new or used. And the depreciation for autos is incredible and yada yada. So get over and read that article. If any of you are thinking about buying a vehicle before year end, get informed, know the facts on the proper write-off you might get. Okay, next question.
Okay, Jack from New York City says, I want to know your thoughts on multiple businesses under one LLC.
Oh, Jack in New York City says multiple businesses under one LLC. Well, Jack, here's the tricky part. Let me give an answer for everybody around the country and then give you an answer specific to New York City. Do we have the whiteboard up? Are we doing sharing whiteboard? Okay. So when you have, let's start with this. You may have ordinary income, or it could be passive or investment income. So if any of you might call our office and go, hey, I need a tax consult. Can you help me save taxes? How should I structure myself legally? Very similar to the question Jack's asking from New York City. If it's passive, so we're over here and we're talking about rental properties, sometimes I do set up one LLC that could own multiple LLCs or multiple rentals. It depends on the equity involved, where the rentals are located, are they high risk or low risk. But I'm not the type that sets up a new LLC for every rental, and I don't want to put 20 rentals in one LLC either. It's somewhere in the middle, and a little bit of consultation can go a long way to helping you get the proper asset protection with an affordable price. So that's this passive side. Now, I have a feeling Jack in New York is saying I've got multiple businesses. And he's saying, what's the benefit of going into one LLC? Oh, it's like kind of asking, like, how does a watch work? This is a big question. Jack, everybody out there, first, if you have ordinary income and you run it through an LLC, your self-employment tax is going to be off the chart. So our number one goal on this ordinary income side is we need to get income going through an S corporation. The S corporation allows us to save self-employment tax, pseudo FICA, blah, 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 the F word, FICA, in a big way. And so ultimately what we're going to try to do is use the S Corp to create some self-employment tax savings. So that's point number one for all of you around the country. So if you have multiple businesses, and I have multiple businesses, I still only have one S Corp in my life. And I funnel it into here. This is where I do my salary for myself, even though I may own a law firm, an accounting firm, a trust company, real estate, and URLs, and hair and nails, and salons, or whatever. I could do all those. If they're ordinary income, not rentals, I'm going to funnel them into one S Corp. That could be an LLC, Jack, taxed as an S Corp. So that's okay. So, Jack, the basic answer is absolutely, you want all your ordinary income funneling, if possible, into one S corporation, which could be an LLC taxed as an S Corp. The tricky part is that S corporations are treated very differently in California, Tennessee, and the 5 boroughs of New York City. I would recommend that you get a consultation with one of my attorneys, Devin Munns. He has written some articles on the best tax strategies for New York City and operational income. He's got all sorts of charts and graphs. He loves that stuff. He eats it up. He's almost completed his CPA. He's been an attorney with us for years. I love him. He's excellent. If I'm grooming to be a mini Mark, it's Devin. He's awesome. Schedule a half hour to an hour with Devin. Tell him you're in the 5 boroughs of New York City and you've got operational income and you're trying to run it through one entity. I know Devin will save you money. The question is how much and what the structure will look like. All right, next question from around the country. Who do we have?
Okay, Mr. Bando asks, I'm moving from California to Rhode Island next year and looking at multi-units. Should I buy as an individual or an LLC?
Okay, and his first name, or what was the handle?
Mr. Bando.
Mr. Bando in California says he's moving to Rhode Island. Boy, that's like going from, the equator to the North Pole in difference of lifestyle and population, obviously, right? So, great, getting out of California. I moved out of California after living there 8 years as well. Love the people there and the weather, but there's a lot of other factors that just can seriously wear you down. So I get it. Moving out of California to Rhode Island. And then the question was, I'm going to be doing multi-unit rental properties in Rhode Island. Love it. And he said, or she said, should I have an LLC? No offense, but I can't emphasize enough. The answer is yes, yes. There's no other choice. You should never, ever, ever put it in your own name. If anything goes wrong with those rentals, with any of the tenants, you're now personally liable. Judgments against you, possibly for the rest of your life, that could never be bankrupt or be paid out. You could have garnishing, assets taken. It's a nightmare. Never, ever, ever own a rental in your own name. Now the question comes, well, how many rentals do we set up, and typically you're going to close on the property, then deed it over to the LLC. Don't worry about the due on sale clause. No bank's ever going to call the due on sale clause when you're deeding it to an entity you own entirely. You're still the guarantor on the property, and you'll be fine. Don't run into the bank and ask permission. They've already sold your mortgage 5 times over. You got a servicer you don't even know who they are. Just pay your mortgage on time, deed it into the LLC for protection. And what I've written up here on the board is the trifecta, where you're going to have short-term operations, long-term holdings, and you're going to set up an LLC owned by your trust, of which you are the beneficiary and the trustee. So you're 2 steps away from this property. In this multi-unit, let's say it's 4 doors, you're going to have this multi-unit owned by an LLC in Rhode Island, and that's your entity. So very straightforward. Get a consult for an hour with an attorney. We help clients around the country. We set up entities in Rhode Island. We can help you out, but don't go to an online website and just set up an entity and hope you did it right. Get a consult this first go around, especially if you're asking, should I even have an LLC in the first place? Next question.
Okay, Marissa in Orem, Utah says, I have a rental in an LLC that I would like to move back into. Can I transfer it into my trust and transfer the one in my trust to my LLC?
Okay, Marissa in Utah says she has an LLC with a rental property. Okay. Now she says she also has a trust, which is very, very common. We want all of our clients that own rental real estate or businesses or assets of any sort, young or old, children or no children, single or married. The revocable living trust is your trifecta. Just like I was saying, you've got operations, a W-2, everything flows into your trust. This is the trifecta: operations, holdings, trust. So Marissa has a home, primary residence, that's owned by her trust. Then she has a rental property in her LLC. She's in Utah, so there's no transfer tax to move rental properties around, which is wonderful. And she said, can I move the rental into my trust and make it my personal residence? And then the home I'm in now, I'm going to actually make the new rental and transfer it to my LLC. The document to do this would be called a warranty deed. And the answer is yes, you can do this. And I think it's great, and I love it. You're going to keep good records of what this rental property, how this rental property was treated on your tax return for the years you owned it. There'll be depreciation that's been carried forward inside that, but you're going to turn it into your new home. And you're going to take your current home and turn it into a rental. Very common. Don't see a problem with it at all. Use a warranty deed. If you want to call our office, Brady is our deed and transfer department manager. And you can reach Brady at kkOSlawyers.com, and he will help get those two deed transfers completed if you need help. All righty. Next question.
Okay. E. Blackburn on Instagram is up with a Roth. It's per your amazing advice. I struggle to know what to invest their money in. Any tips?
Okay. And first name again?
It's a handle, E. Blackburn.
E. Blackburn on Instagram said he has set up Roth IRAs for his kids. So let's do 2 kids, since he used the plural of kids, not just one child. And this person, let's assume that they might be married, just to kind of give us a little more to work with here. You could be a stay-at-home mom or stay-at-home dad. But very kind words. They said, Mark, we've set up Roth IRAs for our kids per your advice, and they're very happy about that. I thank you for saying that. I think this is absolutely critical. We need to get our kids saving sooner, teaching savings. I love the Acorns app. Even Robinhood is good, but they don't have the Roth IRA in Robinhood. You can use all sorts of broker-dealer apps nowadays to do savings and teach your kids how to save. Well, E. Blackburn says that the kids have Roths, and the question was, I struggle on what to invest in. Well, what I tend to say is and again, I'm not a licensed financial planner. I just meet with a lot of rich people. I invest my money too. I get a lot of feedback from people around the country having very different experiences with financial advisors around the country. I don't see good financial advisors and bad and only one of the two. I see both everywhere. So I'm just going to share my thoughts on what you should probably invest your Roths into. I'm going to go with 3 stages. Stage 1, Stage 2, and Stage 3. A lot of these stages depend on a couple things. First, the amount of money you have. Sometimes you just can't invest in bigger deals until you have a little more money to play with. Number 2, they also depend on your risk tolerance. Some people are very, very risk averse and they just want very simple investments. And third, your skills and how much you want to study on your options of what you can invest in. So I'm going to just run through these stages. Stage 1, in my opinion, would be just simple ETFs or mutual funds. ETFs are exchange traded funds. These are new on the market. You can get no load, where there's not a fee paid to invest in these ETFs. There's mutual funds that have been around for a long time. Same concept. Some are no load on the way in or way out. And you may just invest in some basic funds that are very, very diversified. In these situations, I'm just going to say my opinion, you're going to see at best somewhere between 4 to 8% if you're lucky on a rate of return. I would recommend you're very, very cautious about the fees you might be paying to get into these funds or with financials advisors, or wherever you may be. So Blackburn, even with a $1,000 Roth IRA, you can invest in an ETF or a mutual fund. Very straightforward. Put the Roth with like a TD Ameritrade app or a Scottrade app and just keep it simple. Stage 2 is you're like, you know what? I've done some research. I want to buy into stocks that are companies that I'm very familiar with. I've been doing some training and feel like I don't want to use the word day trade. That can mean a lot more than it may mean to others. So we're talking about you taking active participation in buying individual stocks. Also, you may be buying precious metals. You may say, I want to buy some gold. I want to buy some silver. There may be some different investments even as cryptocurrency or something like that that could be fairly aggressive in some people's opinions as well. But this is where you're going to stage 2, and you should know what you're doing before you go to stage 2. Now you can do this again with a $1,000 Roth IRA. So with your kids' Roth IRAs and your own, you're going to have to say, how aggressive and how much time do I want to take learning these things? So you can graduate to stage 2 whenever you're ready. But in the meantime, just keep contributing and stockpiling money in stage 1. Now, stage 3 is my favorite and what I do, and we help a lot of clients with that, and it's called self-directing. And in this scenario, you're going to move your money to a trust company that allows you to invest it in whatever you want, not just what's for sale in Wall Street. Matt Sorensen, my partner, has a book called the Self-Directed Ira Handbook. Let me give you the website for that. It's sdirahandbook.com. It is the, oh boy, I did that badly. It is the #1 book sold on this topic in America. Okay, I've got to focus here. sdirahandbook.com. Now, if you can get over there to that website, you can pick up a copy of the book. You can also get it on Amazon. Now, self-directing allows you to pool your money with other retirement accounts. So it's very common to see mom, dad, kids all in the same LLC, and they pool their Roth IRAs or their old 401ks, and they can go out and buy rental property. They could invest in notes, other investments that can get a significant rate of return because you're investing in an industry you're familiar with. And I should have gone back to this. In stage 2, I see a lot of clients that are getting 10 to 15% rates of return doing their own day trading or getting highly involved in the investing of individual stocks. It can also be more risky. And then when it comes to self-directing, it is very common for us to see our clients getting 15% or more in self-directed type investments. So I know that was a long answer. I'm sorry, guys. My marketing teams are like, come on, move it along. But when someone asks, what should I invest in? Why are sunsets purple and blue or yellow or whatever? It's a huge topic. So hopefully you can see that progression of getting more educated and getting more engaged and involved in your investing, whether it's a $1,000 Roth or a $1 million Roth IRA. All right, next question.
Okay, Chris from Indiana asks, if you have an LLC and an S Corp, can the S Corp own the LLC and pay taxes through the S Corp?
So Chris in Indiana says, if I have an LLC and an S Corp, Now, what typically that means to me, when someone just throws that off the handle, is Kristen's got an LLC with a rental, and she's got an S Corp with a business. Again, this is operations, and this is investments. Now, Kristen, if this is the case, I'm going to come to option 2. If this is the case, here's your trifecta, and your trust owns the 2 entities. Your holdings are over here. Your S Corp would never, ever, ever own the LLC on this side. Your trust would own both. We want them funneling in separately with 2 different types of income. Now, let's say Kristen not only has an operational business, but she partnered up with someone to open a little bakery down the street. And she's like, maybe she's helping out with the menu, she's invested some money, she's working a couple days a week, and that's an LLC with a partner. Now, Kristen, that is an operational entity, not partnering for a rental property. It's going to create ordinary income. You're going to have a self-employment tax concern. Should you own that? Should your trust own it? Nope. I want your S Corp to own it. And your partner's over here, and you guys are 50-50. So this is very common. When I have one S Corp in my life, and I have it own multiple LLCs. Talked about this earlier already today. So Kristen, it is very common to have LLCs that are generating operational income funnel into an S Corp. And this is where you do your W-2 and write off your auto and home office and all these goodies. But if it's a rental, long-term hold, investment LLC, it has nothing to do with your S Corp. Do not commingle them. All right. Thank you, everybody, for your questions. I hope this is helpful or fun, enjoyable. I love this. I'm grateful to be here with you today. Lots going on before year end and tax strategy deadlines. We recorded a podcast 2 days ago yesterday on 16 different year end tax strategies. Please go listen to it. These are the ones that have to be completed in the next 2 to 4 weeks. All right, next question.
Okay, Hannah from San Diego says, I bought a duplex in 2019. I live in one unit and rent out the other. I plan on moving out and living with my future in-laws. If I decide to sell the property, do I pay capital gains?
So Hannah lives in San Diego. She bought a duplex. And she lives in one side as her primary residence. She's engaged. Congratulations. And she said, at some point, I'm going to move out and we're going to live with my in-laws. Now, because she lives in San Diego, this makes perfect sense because you got to be a millionaire to live in San Diego, unless you want to live like a pauper. So poor Hannah's like, okay, we're going to conserve money, live with my in-laws, and I'm going to sell this. Now, my first comment is, Hannah, if it's cash flowing and it's working for you, think twice on selling. I'd like you to start building up that rental portfolio. But at the same token, this is freaking San Diego. So the chance that you're cash flowing could be a long shot, right? Also, the real estate market has been very, very strong in California, even with the COVID pandemic. So this could be a good time to sell and cash in on some of the equity. So I'm going to put it this way, Kristen. Option 1 is keep it as a rental. And I always like, no matter if you're in the Bay Area, New York City, Westchester County, or San Diego, where it can be hard to cash flow rental, you always want to think about it. If I kept this as a rental, maybe even an Airbnb, could it work out? You want to run the numbers. Option 2, she's going to sell. And when you sell, she wonders if she's going to pay capital gain. Number 3, I want to say if you sell, you could do a 1031 exchange and take all the proceeds and go buy another rental. So this is your number 1 rental. You're going to sell it and go buy number 2. And all you have to do is buy something of equal or greater value. Now I've got YouTube videos and articles that I've written on the 1031 exchange. Go study up on it. If you're going to use this money to just go buy more real estate, 1031 could be a good fit. But if you're going to pay the tax, she says, am I going to pay capital gain? you are going to pay capital gain on the portion that is not your primary residence. This is where you're going to pay capital gain. So you're going to pay tax on this half. Now, the only way you get out of capital gain on your primary is if you've lived in it 2 out of the last 5 years. And then you can exclude up to $250,000 of gain if you're single. So we got to run some numbers, Kristen. I don't know your whole story, how long you've lived there, how much you bought it for, how much you would sell it for, what your gain would be, have you depreciated it, are you going to be married before you sell it, after, are you going to live there at all with your new fiance? You've got there's a lot of questions here, but bare minimum, I can tell you for certain, you're going to pay capital gain on the side of the duplex that's been a rental property. And if you try to get away with it and not pay any capital gain and say this was your whole house, you're going to have problems with the IRS. That would be not even being aggressive, that would be fraud. So you're going to own up and pay some taxes. But again, you could do a 1031 on that piece and it could turn out really well. All right. Boy, we're flying along, having a good time. Next question.
Okay, Malu asks, would you recommend taking the money out of your 401k to take advantage of the no penalty distribution and only 10% taxes instead of the 20% taxes before CARES Act runs out on December 2020, and then put it in a self-directed IRA or real estate?
And it's Malu? Okay, Malu says, asks a question where there's a few flaws in the reasoning. So this is very important, Malu, and I'm grateful you asked the question. Malu said, I've got a 401k, and said under the CARES Act, I can take out up to 100 grand. And he said, there's no penalty, which is true, and I can get a lower tax rate, which is not true. We're going to talk about this distribution if you decide to take it. Then he said, but then I'll roll it into an IRA, right? At the end of that, something like that.
Or real estate.
Or real estate. Well, if you take a distribution, you can't roll it into an IRA after the distribution. You took the money. But you could go buy real estate in your own name with the money. And Malu's first question was, should I even do this $100,000 distribution? This may sound like a very technical answer, but I'm going to make it very simple. No. No, this is a very simple answer. I'm being facetious here. No, do not touch your 401k unless it is absolutely an emergency and you're desperate. That's why the CARES Act passed this law, not to help people take money out of retirement. Too many Americans don't have a retirement. They passed this law and said people could take out 100 grand if they were getting the crap beat out of them this year in 2020. And a lot of people had. So Malu, the first question is, why in the freak are you doing this? Is it to survive? And if it's to survive, I get it. Now, is there a penalty when you take out this 100 grand? No penalty, but you either pay all the tax now or you divide it over 3 years and you take $33,000 this year, $33,000 this year, and $34,000 in the final year. You're going to pay tax on that money based on the bracket you're in. It's not, oh, well, it's a 10% rate or it's a 20% rate. No, it's not. It's whatever your freaking rate is. Well, I've read the CARES Act. Unless I'm missing something, and you can email me and go, Mark, you're dead wrong, but you're going to pay federal and state tax of that on that 100 grand over the next 3 years. And once you do, there is a provision that says if you, by the end of the 3 years, you want to put the money back before the 3 years is up, you can put all the money back in your 401k and you'll get a refund for the taxes you paid along the way. If that was what you wanted to do. Typically, you're not going to pay tax on the third chunk because the 3 years would have expired by the time you paid the tax on the third piece. But you can put it back. Once you put the money back in the 401k, then you could roll it to an IRA. So you could roll this out to an IRA if you put the money back. That's why your question kind of threw me off. The only way this is going to get back to an IRA is if you put the money back into the 401k and get a refund for the taxes you paid along the way. Now, your IRA could buy real estate, your 401k could buy real estate, or you could take this 100 grand and go buy real estate in your own name. But again, Malou, I don't know what your personal predicament is and what your long-term goals are, but I'll just say in general, and this is truly what I think you would hear from 90% of solid financial advisors, CPAs, tax lawyers. They would tell you, leave your 401k alone. Keep investing it, grow it, roll it to an IRA, go buy real estate with your IRA, self-direct it. But don't pull that 401k out unless you desperately need it. Leave it alone. All right, next question.
Okay, John from Maryland says, can I operate different kinds of businesses under one S Corp? Businesses are rental properties, travel agencies, and medical clinics.
So John in Maryland says, can I run multiple businesses out of an S Corp? Yes. And then he said he gave an example of real estate rentals, then
travel agency and medical clinic.
Okay, rentals, medical clinic, and a travel agency. And this is John in Maryland. Okay, now, his first question is, can you run multiple businesses out of an S Corp? Yes. I've said it twice earlier today in questions in a variety of ways. I have one S Corp in my life. I want all of my operations to go through it. So in this example, John, you could run the medical clinic just as a DBA into the S Corp. You could form an LLC for the travel agency. You could do multiple URLs. You could sell books. You could sell lemonade. I don't care. You could run all those things through an S Corp, and I recommend it. I think that's a great idea. Now, that's for tax purposes. Some people would go, well, Mark, you're exposing other businesses to each other because everything's in one bucket. If something goes wrong with the medical clinic, they could get at this website business too. That's true. If you run multiple businesses in the same entity, they could have exposure to one another. So this is why a lot of times we set up these LLCs that can help shelter or protect the parent from the subsidiary. I know this looks a little ugly, but this is very common. So John, you're okay. But notice what I said here, and I'm going to put it in red. You do not put rentals in an S Corp. Never, ever, ever. And I meet clients from time to time where some nut job accountant that's 90 years old put a rental in an S Corp. Not good. So rentals, John, go over here. This is where your LLC is for your rentals. Keep a firewall. These are assets. These are operations. And I know I keep harping on that, everybody. It's really a fundamental principle that has helped, I don't want to be too bold to say, but at least thousands of people around the country since I've kind of owned this. I teach classes to other attorneys and CPAs around the country, and they're like, this is spot on. Why aren't they teaching this way in master's programs in law school? This makes so much sense. And there's other attorneys that teach the same concept, but I'm kind of out there really pounding this drum of the trifecta. So John, use the trifecta. Assets and rentals over here, operations over here. One S Corp if you can. Love it. Next question.
Okay, Tyler from Philadelphia says, I want to start a business with a friend. I was planning on doing a 2-member LLC for this. But since LLCs don't save taxes, I also want to set up my own entity, eventually an S Corp. And that entity will be the member of the LLC. Since we will not be profitable in the first year, it may not make sense to do this out of the gate. Can I use myself as the member of the LLC for now, then eventually transfer my share of ownership to an S Corp down the road?
And first name again?
Tyler.
Tyler in what state?
Philadelphia.
Tyler in Philadelphia, Pennsylvania. Tyler, I'm just going to say yes. Now let me restate his question for everybody else. He says, I'm starting a business with a partner. It's an operational business. And we want to form an LLC. And we're going to both own it 50-50. That's great. But he goes, Mark, I'm concerned because I know LLCs do not save taxes. Tyler said we need an S Corp, but having an S Corp between partners is not a good idea. And I agree, Tyler. So Tyler said, I eventually want to have my own S Corp right here. And then Tyler down here will own his S Corp. And he said, until we make enough money and that transition makes sense, can I just be the member up here until I get the S Corp set up? And the answer is yes. Absolutely. Tyler, I couldn't have said it better. Your question is spot on. So in 2020, get this business rocking. Get some money coming in. Make sense of it. Figure out each other's style. Make sure this partner is the one you want to be working with. Make sure everything's working well. Then, as your income grows in this operation, set up your own S Corp. And this goes back to John in Maryland. This S Corp can have multiple sources of income. So Tyler, you may set up the S Corp even sooner because you've got other fish to fry. You may be doing other projects over here before this one is even profitable. And that's cool. So you set up the S Corp when you need it. And yes, it can slide in and be the member of your LLC when you're ready. Love it. We can help do that every day of the week and twice on Sunday. This is what we do. So give us a buzz if you need any help. I'll also notice people how every time I start out an example, I put a line down the middle of the paper. It just makes sense to me. I want it to make sense to you. This is the trust. It's going to own the S Corp. And the trust would own Tyler's home. The trust is going to be the beneficiary of his life insurance. The trust is going to own his LLC with his rentals. So as Tyler's building his operation, we've got a foundation that we're working and building upon. Just makes sense. Next question.
Okay, Sean from California asks, is a mortgage broker considered a real estate professional if they run an Airbnb and meet the 750-hour requirement?
Okay, Sean in California says, does a mortgage broker meet the definition of a real estate professional? Then he threw out, and I manage an Airbnb and put in 13 hours a week, which would be 750 hours a year. Sean, you're trying to ask the question in a way that I'll say yes. I don't know if I can say yes. Let's back up for a minute. A real estate professional is a two-part test. You can't say it the way you did and try to get past that. The first question is, what is your occupation? What's your day job? That's test number one. The second test is, have you done real estate at least 750 hours this year? Now, I have clients all the time that are a 40-hour-a-week pharmacist, and they still put in 750 hours a year managing an Airbnb. Does that make them a real estate professional? No, because a pharmacist doesn't meet test one, and you've got to meet both tests. So let's assume that Sean, his only hours right now are 750 hours a year doing an Airbnb that he owns. And this is his, and he's managing it. Sean, I'm loving it. You've passed off test number two. Here's the trick on test number one. A mortgage broker does qualify as a real estate professional occupation if you are a greater than 10% owner of the company. So, if you are just a W-2 mortgage officer, mortgage broker, and you work for a big mortgage company, and you just get a W-2, you do not meet test number one. I'm sorry. You have to be an entrepreneur as a broker, real estate, a realtor, a broker, as the owner of your own little S Corp, a contractor. Another example would be, let's say you build homes and you're a contractor. Are you a real estate professional? Yes. Let's say you're the foreman for the contractor and you're the one really building all the homes and the contractor just drives around in his truck eating donuts. Is the foreman a real estate professional? No, not for this test because he's a W-2. He does not own the business. You've got to be the professional. You can't work for the professional. So Sean, I don't know all your story, but let us know if you need to do a consult and we can help you get over that threshold maybe. Next question.
Okay, Diego from California says, is there still time to start an HSA and claim retroactively?
Diego says, can I form an HSA, which is on our asset side? It is like a supercharged IRA for healthcare. I love the health savings account. He is asking, is it too late to set up an HSA this year? And then he kind of throws in and fund it and then reimburse myself for last year or expenses this year. If you break that down, it's really three questions. Can I set up an HSA this year? Number two, can I still fund it? And number three, can I reimburse myself for expenses in 2020? Was that, Jack, does that sound about right? So I love it how all of you folks ask these questions where you're hoping I'll just say yes. And I'd like to, I do. We're going to try. First, anybody out there that wants to set up an HSA account, you don't have to go through your employer. You don't have to go through a bank. You can set up a self-directed HSA at Directed IRA. You just have to find a third-party company that sponsors HSA plans. It's not a health insurance plan. It's a IRA for healthcare. That's really what it is. In order to qualify for an HSA, Diego, you had to have had by December 1st in place, already in effect, a health insurance policy for 2020 by December 1st that was a high deductible plan that qualified. So if we look at the calendar of 2020, here in December, 12/1/2020, you had to have had your health insurance high deductible health care plan in place by December 1st. If you did, we can at least set up your HSA right now. That's step one. Now, if you did not, you're looking at an HSA plan for next year. Can you fund it now? Well, the beauty is, if you qualify to set up an HSA right now, you have until April 15th of 2021 to fund it. Woo! So that's easy. So Diego, the easiest part of your question is, can I fund it now? Can I still fund one? Yeah, you have until April 15th. The question is, did you qualify to open one up? Then the third question, can I reimburse myself for expenses in 2020 with my HSA that I just set up? Since this is recorded, I'm going to give you the technical answer that is according to the IRS code. And then I'll tell you what kind of the general practice out there is with a lot of people and the gray area. The technical rule is, once the HSA is set up, any expense that you incur moving forward, you can reimburse. For example, let's say now we're in 2020, we're in 2021, and 2022. And Diego, lucky enough us, he set up his HSA right here this week. And he was ready to go by 1/1/20. And he set up his HSA. But another round of COVID hit. He didn't have any money to fund it. And so all he did was put $100 in it. And it's just sitting there. And he goes through 2021 getting back on his feet. And then in 2022, he says, you know what? I'm going to put money in my HSA. I still have a high deductible healthcare plan. And I'm going to go do it. I'm going to put in some money. He could put in money and reimburse himself all the way back for any expense that he incurred during the period he had the HSA set up. So this part in red, he could reimburse himself for any expense and put the money in 2022 to do it. Now, here's what some people will do that's aggressive in a gray area of sorts, is they will start the HSA now, which they are allowed to do if they qualify, put money in it, and then reimburse themselves for expenses they had in 2020 because they funded a 2020 HSA. Technically, going back and reimbursing yourself for expenses before the HSA existed, not funded, but existed, would be pushing the envelope, to say the least. So I'm just going to leave it at that. You meet with your accountant advisor and decide what you want to do there. Okay, next question.
Okay, Sandy from Scottsdale says, I have an LLC I used to buy and flip houses. I bought a house and did the renovation. Now I want to move in and treat as my home. Assume I will deed over to my trust outside the LLC. What are the tax implications for me?
Okay, so Sandy in Arizona fix and flips homes. I call that an F/F, fix and flips homes. This is much like Chip and Joanna in Waco, Texas on the show Fixer Upper. Sandy says that she fix and flips properties in an LLC. She wants to take a home that she just finished and said, you know what, I love this home so much, I want to deed it over here to my trust. And I'm going to make it my primary home. Can she do that? Yes. Is it simply done? Yes. We would do a warranty deed and just transfer it over. But there is one small problem. First, when you fix and flip homes, I'll even ask my producer here in the room, Corey, when I fix and flip homes, what tax is going to hit me first? That I talk about all the time. Self-employment tax, that's right. Thank you. Corey, you're awesome. So he just mouthed that to me, self-employment tax. Okay, that's right, self-employment tax. So if I had met with Sandy a year ago, and if Sandy has somewhat of a decent tax advisor, she's probably made an S election here. So again, Sandy's given me facts that make the answer good for her. She said, I have an LLC where I do flips. Well, is that LLC taxed as an S Corp? If it is, when you deed this property over to yourself, you've got to pay the tax on the gain between what you bought it for plus improvements. So when she bought it, that would be purchase price plus improvements. That equals basis. Let's say she bought it for 300 grand and she put 100 grand into it. So she's into it 400K. But now, when you do this, you have to get an appraisal, and let's say it's worth 550, fair market value. Well, you take the fair market value minus the basis, you have a gain of 150 grand. Because it's in an S Corp, if it is, it's called a built-in gain. It's built into the S Corp. And if you want to just take it out of the S Corp, you've got to pay the tax as if you sold it to yourself. If this is just a plain old LLC, not taxed as an S Corp, done. Carryover basis. Just transfer it to your trust and you're good to go. You won't get a write-off for all the improvements, obviously, because you took those improvements and put them into your own home in this example. If this is an S Corp, talk to your accountant. It's going to be a little more ugly. All right, next question.
Okay, D from New York says, I've been very active trading in my IRA this year. Can I get a computer and expense it like an IRS trader status? How would this be done?
So D says she lives in New York. She's been very active trading her retirement account.
IRA.
Ugh. So she has a big old fat IRA and she's day trading the hell out of it and making big money. And D, I love it. That is great. Day trading, making money in her IRA. Is she allowed to do that? Yes, all day long. Hopefully this is a Roth IRA. But that's another topic for another day. So D says, I need to buy a new laptop. Can I let my IRA buy it? Right? Is that what she's asking?
Yeah.
Essentially? Absolutely no. I mean, no, you can't. No. Your IRA cannot buy you a laptop. And she goes, but I'll be a trader status. You're not a trader. Your IRA is trading. See, that's the difference, D. Now, if you had an S Corp over here, or even an LLC, and you were trading and you met trader status, which I don't think you want anyway, Sandy, because if you meet trader status, then that's ordinary income. That's not short-term or long-term capital gain once you become a trader. So just to write off a laptop, I like your creativity. I like that you're trying to find a way to write off your laptop, but hopefully you've got another side hustle somewhere, and that's where we would write off your laptop. But you're not going to write off your laptop with your IRA money. Nope, not in any way, shape, or form. I don't care if you think you're the biggest trader on Wall Street and everything, all the shiz, but you're not. It's not going to work. So don't try to use IRA money for that. Find your side hustle and let your side hustle buy you a laptop. That's what I would do. Next question. Okay.
Diallo asks, Mark, if I have a self-directed solo 401k and my wife has a 403b that doesn't allow in-service rollovers and for which there is no company match, is it okay for her to participate in my solo 401k?
Okay, so wife, first name again?
Diallo.
Diallo, do it state?
Didn't say.
Diallo, we don't know what state they live in. His wife has a W-2. His wife gets a 403B. And he said they do matching or they don't?
Don't.
They don't do any matching. And Diallo has his own business, typically going to be an S Corp if he has a solo 401k. Let's just assume. And he says, can my wife be a player in the solo 401k even though she also has a 403b? The answer is yes, absolutely. In fact, I'd go a little further, Diallo. I would say, first of all, even if they did matching, I don't care. That's great. They can match. We need to find out how much money she put in the 403b, and then she can come play in your 401k. Probably the biggest thing I would do, Diallo, if you have a successful business and your wife's not getting any matching at that 403b, I wouldn't even play in it. Tell your wife, screw the 403b. You're not even getting matching and you barely can control what it's invested in. It's going to suck. The fees are going to be off the chart. So if your business is successful, just put your wife on the board of directors, an officer of your company, put her in the solo 401k, and let her max out her $19,500 right here in the 401k. Don't even play in the 403b. Now I don't, again, have all the facts, where you live, kids, lifelong plan and all that.
Said he's from New York.
Oh, he's from New York as well. Lots of New York callers today. That's great. New York won't change the equation. Sometimes it does, so I wanted to ask. So Diallo, I would just have your wife play in the 401k exclusively. You tell me what she's getting out of this 403b. Sounds locked down, and she can play in your 401k all day long. So or do both if she gets any matching. All right, next question.
Okay, Tax Clinic on Instagram, lives in New York, says if I take $100,000 salary from an S Corp and I have profit of $300,000, can I take an entire profit as distribution? Does it create an IRS flag?
Okay, Tax Clinic is their handle. Living in New York, says they have an S Corp and they're taking a salary of 100 and a K1 of 200.
It said 300,000 profit.
300,000 profit, $100,000 W-2. Now, Tax Clinic, I'll just call you that. I'm going to assume that when you say profit, you're talking about K1, which is typical. Or in some other people out there, you'd call this pass-through. And then, Jack, I'm going to have you read the question. So, again, this is 400. Now, remember, the Kohler matrix, they're at about 400 grand of income, and they're doing about a 25% allocation of salary. So their salary level goes down as their income goes up, and they're right in here. A 25% allocation of salary, which means total income is 400, and they're doing 25% to W-2 and 75% to K1. I can live with that. I think it's within a range that the IRS is not going to care. It's not worth chasing down. It is a little aggressive, but it's not outside the bounds. Joe Biden in his S Corp took a lot lower allocation, so I'm okay with it. But then the question is what?
That was his question, is if that matrix was okay.
Oh, if that was okay. I thought there was something else, no?
You answered it.
All right. Yeah, I'm good. I like it. Now, I have to say, don't go file your tax return on this, and if you get audited, blame Mark Kohler. I don't have all the facts in your whole picture of life, and distributions play into this too. Because if you didn't take out 400 grand, this is important, tax clinic. You would love this. My matrix is based on distributions or draws, not really what profit is. Now, if you're telling me profit was 300 grand and you're taking 100 of that in salary, so that means 100 in salary, 200 in draws, you're doing a 33% allocation at that point. I'm good with that too. But if you're making 400 and you drop it down to 25%, I'm good with that too. Because you can see what I'm doing, tax clinic, on the ratios. But don't worry about profit, worry about draws. So if your draws have been 400, that's really what I'm going to nail the W-2 down on. I'm being very technical with you. I'm assuming with your handle being tax clinic, you know what I'm talking about. All right, next question.
Okay, Susan from Arizona says, if I never receive the $500 COVID stimulus per child, is there anything I need to do, or will it get handled when I file my 2020 taxes?
Susan says the $500 tax credit or tax payment for COVID, she said, I never received it. When I file my 2020 taxes, is it going to be reconciled, and will I get the credit then? Susan, my understanding is yes, and it'll be based on your tax return income for 19. And if you do qualify for it, there'll be a reconciliation at that point. I'm going to tell you, I do not know authoritatively if that is the case. If I was a betting man and I had $100 here, I would bet that's the case. And I believe that's everything I've read. That's my understanding, is that there'll be a reckoning on your 2020 tax return for anybody that deserved a stimulus check that did not get it. So think about that. Or the care, this is COVID, CARES Act stuff, not the stimulus check. So Susan, I apologize. We may have to do a little research for you on that. Maybe I'll bring it up on my next open forum. So I gave you a very ho-hum answer because I don't know that off the top of my head. And I hope many of you appreciate it when I don't talk like I know everything. So appreciate that. Okay, next question.
Okay.
This is a tricky one, I can tell. I heard a, okay.
So Chris in MD, is that Maryland?
Yep, Chris in Maryland.
I'm the trustee of an investment property that needs a full rehab. The property is owned in a trust. I want to bring in an investor to fund the rehab. What do I do to source the investor or secure the investor?
Okay, this is a really good question. Chris in Maryland says she's the trustee of a trust that owns a property. Is that right? And they want to rehab it. And she said, I want to secure an investor. In my book, the Tax and Legal Playbook, Chris, there's a chapter on partnering. I really recommend that you pick this up. You can get it on Kindle, immediately access, or in the mail on Amazon within a couple days. But read the chapter on partnering. Now, the reason why I say this is a great question for everybody, the I word is a very dangerous word. Investor. Investor means someone's giving you their money with a promise or expectation of some sort of rate of return or benefit. If something goes wrong and they were treated like an investor, which oftentimes means silent partner, and anything goes wrong, it could be criminal. And it definitely would get the attention of the federal SEC or any state securities enforcement. You got to be very, very careful. Let's even step back a little further for everybody. If you're looking to raise money for your business, a rehab, a rental, anything, there's three main ways you can do this. Number one is you can call them a lender. Borrow money from someone. A lot of people want a first trust deed. They want some security, but they also want a piece of the action. You can't have both, people. It's one or the other. So when you're meeting with someone and they go, yeah, I'll loan you $100,000, but I also want 20% of the upside. Whoa, 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 whoa. You want a fixed rate of return with your interest income, and you want to share the profit, and you probably want to lean against the property. Well, see you later, bye. You do not have to roll over for these type of people. They're going to be in one of three columns. They cannot be in two columns. So if you want to borrow money from someone, Chris, go to someone and say, hey, I want you to do the rehab. I'm going to borrow 100 or 200 grand. I'll give you a first or second trust deed. So that way, if I default, you can come in and foreclose and take the property. So the people have a lot of security. They have a fixed rate of return, ROR, with an interest rate. And they're happy. They're done. They're not a partner and they're not an investor. Option two is the partner, which I love. And in their case, Chris, what you would do is your trust would deed the property to an LLC. The trust would form the LLC with the partner, and the partner would throw in whatever capital you agree upon. You throw in the property. See what's happening? You're putting in the property, they're putting in the cash. It's fair. And then you go rehab it and you sell it. And you split the profit based on whatever percentage you agree on. Maybe it's 50-50. I don't know. But they're a partner. There's no promises that it's going to work. There's no promises that it's going to make a bunch of money. There's no promises you're going to give them a rate of return. If they want a rate of return and interest on their money, make them a lender, but not an investor, not a partner. Which brings us to the third definition, investor. By the way, before I explain that, with a partner, you're typically going to have an LLC. It's going to be a democracy, meaning they get a say. There's going to be percentages of ownership, and there's going to be risk. If you don't make any money, they don't get anything. Is that what you want? Well, I want 20% of the upside. Well, what happens if there's a downside? Well, I don't want any of that. You give me my money back. That's not how it works, people. If you want to be a partner and get the up, you got to take the risk of the down. You got to choose one. Now, investor is where you're going to get this registered with the state and federal Securities and Exchange Commission type departments. They're all a little different around the country, but the Fed's SEC, and you're going to raise capital. This is like a crowd fund. This is a PPM. This is a 504, Reg D, blah, blah, blah. There's in my office, the person that would help you create an investor relationship is Jarom Bergeson. Jarom, that's Jarom, Jarom Bergeson. And you go to Jarom and say, Jarom, I want an hour of your time. Tell me which one is best, investor, partner, or lender. Pay an attorney for 1 hour. Get a plan, Chris. But if you're anything like my typical clients, you're generally going to be here in the middle with an LLC. And we can set up the LLC too. Next question.
Okay, last question.
Last question.
Kristen from South Carolina says, is a solo 401k the same as a profit sharing 401k? Your office told me to open a solo 401k for my husband and I. I called our financial advisor and he was calling it a profit sharing 401k.
Kristen says, is a profit sharing 401k the same as a solo 401k? She said, your office set up a solo 401k for us, and then she called her financial advisor. And Kristen, one side note, your financial advisor has nothing to do with your solo, and they know that. And so they're not going to be very helpful. They're going to say things that make you sound dumb. They're going to say things that make you sound like you did something wrong, because financial advisors, in some instances, I know I have advisors that are watching or listening, There's a lot of advisors that are very helpful, and they don't mind if their clients buy real estate or do a solo 401k or a self-directed Roth. But there's other advisors that are very territorial. And Kristen, I don't know the advisor you have, but if they're trying to mesmerize you and say that you have a profit sharing plan like you did something wrong, they're full of crap. They're the same thing. Same thing. A solo just means that the only people that can play in it are husband, wife, and kids. In this situation, you're the only ones that can be in it. That's why it's a solo. But if you want to put in $19,500 and the company is going to find out what its profit is, and there's some profit sharing or company contributions or matching, they're all the same type of terminology. And you're going to be fine. If you felt like there's mistakes or a concern, and we set up your solo 401k, everybody out there, we charge $9.99. There's 1 month out of the year where we provide a special. That special's gone, but we're $9.99. You get an hour with an attorney. And Kristen, whoever the attorney was in my office you talked to, get them on the phone for 10 minutes and go, why am I here getting mixed messages? Why is my financial advisor making me scared or nervous? And typically, again, it's because they want you to stop what you're doing and let them invest your money. We want you to invest your money into what you know best. That doesn't mean you still don't have some money in Wall Street and some ETFs and mutual funds and some basics and keep some liquidity there. Financial advisors play a very, very important role, but not for everybody. Everybody's a little different. So, Kristen, hopefully that's helpful. Well, everybody, again, I want to just mention we are on the cusp of the December 31st deadline. This is a very, very big deadline. There's, like I said, yesterday's podcast, mainstreetpodcast.com or Main Street Business Podcast. You can go to either one. You're going to get there, Main Street Business. We recorded a year-end strategy session with 16 different deadlines to be aware of. Please go listen to it. You can get to it on Stitcher, Spotify, or iTunes. We have over 1 million listens now on our podcast. Please check it out. The next thing I was going to say is if you're an entrepreneur, if you have an entrepreneur in your family and you want a gift for them for Christmas, I have 3 different gifts on my website. One with a budget in mind for 3 different scenarios. A book signed by me, $25 or so, I think, right? And then a $50 value, $99, and then $150. So the $99 is essentials with multiple books, and I think it includes the calendar. This is $99.
8 steps and your
8 steps in the books, and then the $150 you get a calendar and a few other bonuses. So I can't remember what they are. They're freaking awesome. My marketing team did great. Just it's a great landing page too. But get over to the website and you can markjkohler.com and look at the different Christmas gifts that might be a perfect fit for the entrepreneur in your life. So thanks everybody. Don't give up. And we'll see you next week for another live broadcast on YouTube and Facebook. Thanks.